And what turned out to be a relatively flat day, there was very interesting developments and moves inside of this pretty much the same range as we had Friday, and for that matter, the same range that we had after we gapped on Thursday through that resistance level. So we're going to break down, as we've been so sideways and flat, what's been going on underneath the hood, so to speak, and what that might mean about both, with what the short-term implications of that might mean, and how that might impact the intermediate expectations we have going into this next month and into the end of the year. So I'm going to break all that down from a technical perspective, what's driving some of this action, and then we'll take a trade idea looking at something that was in the news today and how we might be able to trade that. So let's go ahead and get started. Today is Monday, September the 9th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. Of course, we still continue to have a bullish posture, intermediate line close to crossing back above that market sentiment level. You can see that's what's one of the signs of starting the intermediate run previously. We do have the dark green shading, obviously, because we're rising above the 50th percentile. But you notice also that the intermediate line is still falling by a couple of points here. That means it's yellow, and it will stay yellow tomorrow because of that. And that's not the bullish combination, right? The bullish combination is to get the dark green shading in the green line, and that might take, we can turn around. They did here, and actually did over here too. Ideally, you'd like to get them kind of at the same time. That these are kind of more recent anomalies. If you take a look at the Russell 2000. You can see it broke out today in a big way, closing above these highs. Finally, kind of getting to where the S&P was, though. If you look at the 8.8 high point, we're still below, and the 8.8 high over here on the S&P, we're well up above. So it still hasn't completely gotten above through these levels, but at least, again, we're back to having a yellow line, and we don't have the dark green shading yet, and we don't even have the blue line getting into the upper reversal zone yet. So I mean, it's a better condition than what it was, but it's not the bullish condition in the least, right? In fact, you're even if the near-term line stops here on the Russell for whatever reason, it would be a lower near-term high point with which a much higher high on the index itself. So that would be your bearish divergence setting up. So again, we're not out of the woods here, and ideally you'd like to get that. That same bullish combination on the Russell 2000, if not first, at least at the same time as what we're seeing on the S&P. And of course, we're not. You can see on the Dow, it's very similar. We are well above the 30-day moving average, but since we were so far below it for so long, it's not turning up yet. And the Nasdaq's actually looking a little worse. It just barely did get above the 50th percentile. And it's rolled back down here a little bit. Still has a bullish intermediate, second day of bullish intermediate confirmation signal, the combination of an oversold momentum line and a bullish posture. All right. So to kind of summarize the market forecast positioning, it's still bullish. It's not back up the truck bullish. It's not bullish to where we expect a 1 to 3 month rally out of this, and that could very well be the case. More than likely, we'll probably get some after this little semi breakout. We'll get some kind of retest. Doesn't mean that we'll go back down, and most likely won't even retest these Fibonacci levels. But I wouldn't be surprised if this dotted blue line is the bigger retracement area, that we don't pull back into that area and probably get into this upper state. We'll probably stay in the upper half of this intermediate runs range. You don't see that 50% mark, but it's in between. Obviously, midway in between the dotted blue lines, midway in between these orange lines. Probably down about 28, 80, 81 in that area. That's probably the worst it would get on any kind of retest. Then the turnaround, then you probably will get the Russell participating at that point, and you feel a lot more confident in the sustainability of any new intermediate run. That yes, we are bullish. It's not strongly bullish, and for all these other factors, we're doubting a little bit the sustainability of this current intermediate rally defined by that intermediate line rising up above 50. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen, then hit that red subscribe button that pops out. That will notify you when these videos are posted. Hit that thumbs up icon that's down below the video. That tells me two things. Number one, you got something out of the video today, you liked it. Number two, you want us to do the video tomorrow. So it's a quick way to give us feedback. If you like these videos, if you watch them day after day, let us know. The only way we know is when you click that thumbs up. So you can do that right now while you're watching. If you want us to do it tomorrow, you plan on watching again. Also, while you're down there, comment. What did you get out of the video today? As new people come and check it out and look at the comments to see why you watch it, what did you get out of it? Let them know that down there. Join our daily market outlook email list. There's a link popping out up there in the top right corner of your screen. Follow me on Twitter for more content in between the videos from day to day, and join our daily market outlook community that we've created on Facebook. All right, if you're watching here on our blog, a reminder that we have our Market Outlook live videos every day at 3:30 p.m. Eastern Time, where we monitor some trades. We actually did closed out a trade here today, one of the previous Market Outlook trades that we've done. So you can check out that video to see how we manage those trades, as well as we put on today's trade before the market closed. So again, to get access to that video, it is for Plus and Premium subscribers. You actually you can get a 30-day trial to our Plus subscription by clicking on this link down here, and these are the classes that you get in addition to access to those live videos. There's the rest of our calendar over here on the right, which the classes that we have coming up here. In fact, tomorrow's one of the classes you get with that subscription is this one of our most popular classes that we have here, the Dividend Growth Investing class. We also invite you to engage with us on social media. Again, the more you engage with us there, the more they will put our stuff at the top of your timelines. Not everybody who follows us sees our content. To make sure, if you follow us on Twitter, to make sure that you do engage with us. So it's really easy. It's clicking that little heart, opens up that window, and like the tweet. That simple. You can also click this image. Same thing with Facebook. Facebook's actually more notorious than Twitter in that hardly anybody that follows us, I would say probably about less than 25% of our followers see our content. So again, to make it to where you do, and they put it at the top of your timeline, just engage, like, comment, retweet, and then they'll know that you like that content, and they'll make sure you see it tomorrow and every day after. All right, so because of the relatively flat start, we started out with a really bullish candle this week, and again, if we do come into this 2880 range, which would be 2881, you can kind of see what kind of candle that would produce. And I mentioned before, you going back to this example, when you get the transition, you get the bullish reversal here. Without that pattern developing so far, that's a pretty bullish pattern. And again, the expectation when you get these bullish reversals is 1 to 3 months. So that's 4 to 13 weeks of these kind of bullish Hakunashi candles. And of course, you can see when you look at the regular candle, we'll see if that ends up being the case. But good bullish week last week, closing above those highs. The problem is it's that Russell 2000. If you look at its regular candle here, it's still below its 200-day moving average. Today crossing back above the 50, but you can kind of see why it's still lagging so much, and why you're just not too confident about the sustainability of any good intermediate rally like we saw when it came off of these big deep lows. When you look at the 3 green arrow chart, you can see we got obviously the 3 green arrows, but not the rising moving average yet. That's why we still got the yellow line there. Same thing with the market forecast. That's why they work so well together. If you take a look at the 2-line version of the 3 green arrows, the 8 and the 17 are both now above the 30. So that's kind of like the next reversal pattern. Now you notice, you can see by the time we get that first surge, that you can see on the histogram here, you got the light green shadings and the dark green shading. The dark green obviously is when you start pulling back. And just because the histogram starts pulling down doesn't mean the index itself starts pulling down. you usually start with a surge in the histogram that gets the MACD through the 0 level. It gets the 8-day through its 17-day, and then as they both cross, it usually occurs on the downhill slide, on the downhill of this first surge, and then that's where your MACD eventually peaks, and then you just start diverging, right? You can keep going up, but you still have higher highs, higher lows, and so right now you can see that we are the orange line moved up above 0, which is also significant. You can see all these other times where we kind of had fake crossovers on the blue line. The orange line didn't get over there. Now keep in mind this is a phenomenon that's unique to the S&P. If you look at the Russell 2000, the Russell 2000 is not above 0 yet either. In fact, its blue line is barely crossing. It's still on the uphill climb with the light green bars. And then of course, this one's a little different. It's higher beta, so its light green can last longer than the S&P, and its dark green doesn't really last as long because it drops so suddenly. Look how many red bars there are here for the Russell. So it is a good sign for the intermediate trend as a whole to get that orange line up above 0. It is a little telling in terms of like this current run that we're already done with these light green bars. And, well, one day doesn't mean we're done, but we'll see if we end up being done. Again, the dark green means that the bar came down from where it was previously. So we'll keep our eyes on that. You can see the stochastics has made its way into the reversal zone. The orange line, the %D, the 5-day simple moving average of the blue line, is now also made its way up above 80. Again, a good sign for the beginning of this intermediate trend. They kind of need that for that to happen. So, there is a lot of good signs that this intermediate rally is starting. What is lacking is the follow-through from the small cap index. All right, so now if you take a look at the intraday charts, here we go. We still haven't filled in that gap. So at worst, at the best here, we haven't taken off and we didn't get up. We kind of got up to a new high, but the reality is, today's high point, compared to yesterday's high point, that's the difference, is that move. So it's not very much. And today's low relative to yesterday's low, that's the difference right there. So not very much of a move either. So the reality is we've had a couple of days in a row, really 3 days when you count the, after the initial surge last Thursday, that we've just kind of stayed here. So we're building up a volume node. In fact, outside of this one, the point of control of the last 4 weeks, it's the biggest volume node that the S&P's had. And it'd be better to get on the top side of this than on the bottom, to have this kind of lurking above us, because again, you've got path of least resistance equally to the downside as you do to the upside. So like I said, not out of the woods yet in terms of this bullish trend starting. It looks good, the trend looks good, but we're not there, as you can see. If you take a look at today's range, if you take a look at today's range and volume, and you see how we're kind of hitting up against that 50% Fibonacci fan of this intermediate run. So we pulled back below the Fibonacci, below the 62%. We're back up now against the 50%. See if that ends up holding for resistance here, at least in the short term. Not necessarily not looking for a new intermediate pullback. Just looking for more of just a short-term retest, and then continuing the intermediate run that we're starting at right now. So the range, just half of the average, very, very small range. 51 million shares down there at the bottom right corner. That's how much volume we've had today. Put that in context. Again, we're bringing these lines down. We're not below the 1% marker yet. That's when when we'll probably just grind our way higher for a while. As you can see, when you get up to that point, you just grind higher once it gets below 1%. And this is coming down from a much higher level than we are now. If I were to go back a couple of years, coming down from more not as high. We didn't get above 2% on this drop, and you can see once we pulled above 1%, we had a little bit of a pullback there, but then we just grinding higher below the 1% mark. Very slow moves, very boring moves. We're not quite to that point yet. You can see where the ATR is, and it's still got room to move to the downside. Remember, today's range is right there. and then the volume at 51 million was down here too. So it's both these moving down is a good sign, not a bad sign. It's actually a good sign for the markets. And finally, look at the volatility index. We were up today. Interestingly enough, if you look at the different asset classes, the VIX was the second highest performing asset class in this list, up as much as the worst performer was down, which usually that's not the case. Usually when it's a risk on move, VIX is down here with TLT and gold and other safe haven. There's a dollar. But that wasn't the case. The VIX is actually up here. It's still in the bullish range. It's below the 90% mark, but it's not, it's not into that lower half. And that's, again, kind of another good sign that this trend has established itself. We're there. Like, we started the intermediate rally. We dropped below 90%. That's what you look for to start this intermediate run. But to really entrench ourselves in this run, to kind of be more long term, is we kind of go up and down through this 85% mark. So to summarize the market outlook here from a technical perspective, before we get into the fundamental drivers and different relationships as well as our trade idea of the day, from a technical perspective, the bullish intermediate trend is starting. It still doesn't have like all the signs of confirmation that full steam ahead, but the train has kind of left the station, so to speak, and we're working our way down. Now we might meet up with some short-term resistance. Usually is the case when you get some kind of resistance, especially the more widely anticipated the resistance breakout is. A lot of times you'll get a retest that will shake some people out, worried about, especially kind of some bear traps, thinking, oh, you can see it's going to fail, and you start suckering in some bears. So that's a possibility in the short term. But as I mentioned, a lot of technical signs saying that the train has left the station here, and that train usually takes about 1 to 3 months or 4 to 13 weeks to get to its destination when you're looking at a weekly chart. And really for this year, that could very well mean into the end of the year. So, if we end up with like a 4-month rally, that takes us through a very seasonally bullish time of year. September is not a seasonally bullish time of year. So that's why it's also kind of likely we get an increase in volatility here before, maybe a little bit of a bumpy ride and some turbulence, mixing metaphors, but before that we get to a nice little cruising speed, altitude, whatever metaphor. You just pick the one you want there. So what do you think? Do you agree with that assessment? Disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below on what you're seeing that would suggest either a much more bullish outlook than what we have, or a bear or any kind of bearish outlook. Share whatever charts or indicators that you're seeing that would suggest that down in the comments below. All right, now let's take a look at what's driving the price action. You can see the unwind is beginning of the safe haven trade. And I think that's what's going to drive this intermediate rally into the end of the year, is this unwinding of the safety trade. Gold and long-term bonds. This is a 6-month return, mind you, a 3-month return. Here's a 6-month return, right? So, even bigger discrepancy here as they pull back, even towards, just break even for a 6-month period. Because these are rate of change numbers, right? So as they break down, come and pull back down, then that will just provide a lift. Now you notice the S&P is already up. Now normally when you're that far up, the S&P and all other equity asset classes are way down here. So they don't have to return to the mean the same way that these two. S&P is already up 8.5%. Now small caps is barely getting across zero. So that's where, again, if we're going to be bullish, that's going to make its way up. In fact, you could see this unwinding is kind of started, at least for bonds, back here on 828. So if you take a look at the time frame here from 828, let's go August, 828 here, starting last week, we'll go about 15 minutes. Then you can see, okay, that small caps is leading, just barely. Started off strong, a little bit of a pullback, and small caps is up now 5% since we started to pull back on bonds about 3%. So we're getting that unwind. You can see it's a full-on move in the risk appetite. Emerging markets are doing well. USO is doing well. Our crude oil is doing well. The dollar is still actually up a little bit, and that's putting some pressure on gold. If we take a look at the charts, let's see over here first. At the chart for the dollar, go back to the 1-year chart, because that's a big driver of what's going on here. You can see we actually were down a smidgen on the dollar. We bounced up, we were down here to 98. We're back up to 98.3. We're actually down. We're not down. This is actually today, the new day that started. But yesterday we were actually up. The dollar made a nice good run here to the upside, coming up from Friday's close, like I said, right at that moving average. So, green line or yellow line, light pink shading typically is bullish. I actually wouldn't be surprised if we don't continue to move to the upside on the dollar. And since we've held the breakout at 98 after a retest down to the downside, you take a look at those other asset classes, especially like the 10-year note. It's working its way towards that downward trending moving average. So, I mean, we don't have a change in trend yet. In fact, when you get the yellow line and the light green shading, that's actually going to be a bearish pattern like we had right here when you came up from towards the moving average there. So we're not, this isn't, the safety trade hasn't completely unwound. There's still, in fact, if you look at the linear regression here, we're still extreme on the 5-year. If you take a look here at 5-year, right there. So there's the 5-year. We're still just barely getting inside the 2-second standard deviation channel. And if you look at gold, you're just barely inside the second standard deviation channel there as well. So plenty of opportunity to return to the mean. For gold prices, we're talking about the Fibonacci, the retracement zone starts at 1450 and works its way down. You look at TNX, and you look at, this has been on much more steady of a decline. If we go from, the top to bottom here, this 2.14% area is probably the first layer of resistance as we do make our way back up to the upside. In fact, if you look at the Bollinger Bands for TLT, which is actually not TNX, it's more TYX. Here's the volume node that we've been building. Look at how little volume there is until you get to that 132 area, which is that equivalent. So again, I think this will be a big driver for this intermediate run, at least especially the beginning of this intermediate run as we pull back down into this area. And of course, breaking through there's another big volume node gap until you get down into this 125 to 120 area, more closer down to 120. Brandon has brought up an interesting development in today's, there on Twitter. If you follow him on Twitter, one of the things he mentioned was value stocks pushing up, really kind of breaking out. You notice this is a 1-year chart, so you notice this is where most of its volume is here in this area. We've traded here before. We were down so much and it's popped back up. So that's a pretty good sign for those types of stocks. Whereas momentum, which has been more bullish and was trying to break out, is hitting up against its own resistance and pulling down. But you notice how much support it has down below. So it's a big day today in terms of value versus momentum, in terms of reversing that trend. So here's the relative strength of those momentum stocks towards those value. And you can see it's been a bullish trend for most of this year for momentum. Had reached a peak here previously in August, and really we've declined. And you can see the big drop when we broke out on Thursday, and then the follow-through drop today. Without the big drop on Thursday was associated with a breakout on the S&P. Today's drop not associated with any breakout. And you notice, as we've pulled back to on the RSI for this relative strength line, this is about as low as we've been. So, we'll see if this was kind of a short-term value play that's lasted a few trading days, or if we break through these lows and value really takes off to the upside. And those are the stocks that lead. That wouldn't be the most bullish environment for an extended intermediate rally for value stocks to continue to lead higher. Those value areas, especially, would be the financials and the financials in the energy sectors. In fact, if you look, those are your biggest winners today. financials and energy, both up, 1.5%, 2% for energy. And if you look at the sector selector rankings that Brandon puts out every Friday on our blog, we'll do the 12 grid here. Those are two of the three worst that we have at the bottom of the list, along with materials. Materials had a down day today. Financials or healthcare, had some kind of industry specific news that pushed it lower. There's the financial sector breaking through. There's energy finally breaking through, kind of following what everybody else had already done. And then on the other end of the spectrum, your big winners, real estate, technology has been one of the bigger cyclical winners. And then you have utilities and staples all lagging behind the S&P. So your momentum players have been your low volatility type stocks, and those are pulling back, and we're replacing them with right now value players, and you would like to replace them eventually with these kind of growth oriented. You want these to kind of take over the momentum mantle, these cyclical areas. That will make for more of an extended run. You might be, if yields do make a short-term rally here, pop off oversold conditions, that will help this financial sector. But unless the dollar breaks down, that won't help the energy sector. In fact, this might end up being a really good selling opportunity for those stocks that have made some runs that you might not have a whole lot of trust in. Some of the weakness that we see in the technology area showed up in Facebook today. So Facebook, if obviously in the news, it had a little bit of a gain, up 0.68%. But if you look at its pattern here in the market forecast, it's got the light green shading and the yellow line. And if you look at its three green arrows, same thing. You have three green arrows. You have three green arrows here, but you don't have the green line yet. You still have the yellow line. And when you look at that MACD, the histogram already rolling over, when you look at on this two-line version of this chart, you can see similar to what we had back here in December, where the MACD crossed below zero, but we had already started to, the histogram was pulling back instead of continuing higher to get push the MACD up to a stronger level before we rolled over, right? So by the time we got this green bar, the MACD was a much higher level than it is now. Over here, by the time you got the green bar, the MACD was at a higher level, or the dark green bar. Here, when you get the dark green bar, low level. Here, you got the dark green bar, low level. And some of these other ones, you got the dark green bar, you didn't even cross below zero, cross above zero. So a little concerning that yes, we're getting some nice crossovers here, but we're already starting to lose some momentum on this surge, and we're not quite getting the surge to push you through, and it's setting up for a potential bearish trade and bearish pattern to make a leg downward, especially when you look at like the Bollinger Bands here. You can see that it's there. It tried to get off of this value area. It's going through this volume node, and it should make a really strong run, and that MACD should have a lot of strong positive momentum, and it's not, and that's the concern, right? That's the how do I know if a three green arrow chart is this bearish trade opportunity, or if it's going to turn? And that's one of the things you can look at and say, okay, well, there's a good chance it can turn because, that surge in momentum wasn't that initial surge in momentum that gets the MACD through zero, that gets the stochastics up through 80. It's already petering out before we even get those things. If you look at the rate of change for Facebook, so for some of these strong levels, you can see we've been gradually forming lower highs, and that's kind of what we're forming right now on the 3-month basis. Look at its Ichimoku cloud as well, and you can see again why we're not too bullish. See, over here you were below the cloud. At least you're into the cloud, but you're not threatening to break through yet. In fact, you still got about another few days if we continue to move higher to get through. So and you can also see too that we are trading lower now than we did back 26 days ago, which is all not a good trending sign either. So a lot of looks good. 3 green arrows. You have this bullish pattern on the market forecast. bullish intermediate line, but it's so weak that it's looking like it's actually one of those contrarian type, selling the 3 green arrows rather than buying the 3 green arrows, mainly because the 3 green arrows are occurring on a downtrend, downtrending moving average instead of an uptrending moving average. All right, so to trade it, you can see the trade that we've already put in for today. We're going to look to sell that 180. So by October expiration, the Facebook is priced right now to move, plus or minus about 18 points or so from currently 188 down to 172, about 16 points. So we can move down to 16 points. The options are priced for that, or go up 16 points, one way or the other. So a move down to 180 is well within that pricing. So if I were to sell the 180 and buy the 185 for about $1.50, you can see it sets me up, and this is with some position sizing here. It sets me up to take, if I were to, according to this position sizing, I'd take about a $600 loss, worst case scenario, for a $1,300 reward. That's a 2-to-1 risk reward. But the reality is we typically take about half of that loss, is ideally when you get out of these directional trades. So that gives you about a $300 risk, because you can see you lose your $300. Once you're down about halfway, you pretty much just get the trade loses the other half while you slowly watch it suffer, so to speak. So we'll take our losses at the $312 mark. With a $1,300, that's about a 4-to-1. A little bit better than 4-to-1 reward to risk ratio. That's a good setup for a level that it really doesn't. 180 is not that far down. It's basically down to the recent lows that we were just at, about a week and a half ago. All right, you've heard from me now. Now I want to hear from you. Let me know what you think about today's video. Any comments or questions you have. Let's keep the conversation going. In our Market Outlook forums, there's a link popping out right there in the top right corner of your screen. Click on that link to get there. Reply to anybody else's thread, and let's just keep this conversation going with any thoughts that you have in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video. Follow me on Twitter for more content in between videos from day to day, and join our community at marketscholars.com. As well as the community that we've created on Facebook. So have a great rest of your night, everybody. We'll see you all tomorrow.